Debt, bailouts, brawls in Parliament. Is it finally time to say arrivederci to the Eurozone? I'm Alan Barton. Stand by for the front page. Joining me in the studio, YARON Brooke, president of the Ayn Rand Center for Individual Rights, and Terry Jones, associate editor for Investors Business Daily. Terry, we'll start with you. What happened this week in Europe? What's the big deal with this deal that was cut? Does it work? What are they doing?
Well, after a year and a half, they finally came up with something that will, at least for now, appease the bondholders.
And the basic problem there is the problem everywhere. They're running out of money because they have a bunch of entitlements they can't afford. Is that the simplicity of it, or are we being too simple?
No, that's exactly it. I mean, the five major debtors in Europe are 7% of GDP in terms of their deficit. That might not sound like a lot, but it is. And there's no hope for them cutting that down anytime soon, unless they were to cut their spending. But they don't want to do that. They have a model that doesn't work.
So they're basically constantly refinancing the loan, refinancing the loan, refinancing the loan.
Kicking the can down the road. And they're going to do it some more, but this time at a cost of well over $1 trillion.
Yaron, the markets seem to like it. Stock market had a great day yesterday on the news, although apparently today Italy's having trouble. Their bonds, the yields are not what they wanted to coming out of the gate. What do you think of this deal?
The market's just looking for good news. And look, the market likes it when money is printed. Money's printed, it usually enters through the banking system. Stocks go up, people expect that. And what this ultimately means for Europe is they're going to, over the long term, print a lot of money. They're going to have to cover all this. They're going to have to recapitalize the banks. So that what happened in this deal is the banks in Europe agreed to take a 50% haircut on the values of these bonds, which means they have
the Greek debt.
The Greek debt. So it means they have to write down all their Greek debt by 50%. This is a huge number. Now they have to, and the second part of the plan was the banks now have to go out and raise capital. They have to go out and get stock. There's not enough money out there to recapitalize all the banks. So the only way to recapitalize them ultimately is for the governments to recapitalize them. And where the government's going to get the money, ultimately they're going to get it from the European Central Bank. Ultimately this means more printing of money, more bailouts of banks and countries and so on. And it's just kicking this can down the road.
So who's ultimately going to take the haircut on this? The bank and shareholders in the banks, probably?
Those who hold the debt today are going to take a big haircut, but so are, for instance, German taxpayers who are going to take a big hit to their taxes. The banks, which own literally hundreds of billions of dollars of this debt, are going to take a massive hit. And ultimately, consumers around the world are going to take a hit because there's going to be a lot less bank lending.
And what about gold? Gold has come off a little bit from its sort of, kept on going up, 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 and I guess it's gone down about 20% since its high this year. But people have been saying it's still in a bull market because all around the world, the currencies seem to be devalued while they're doing this. They're printing currency to solve problems. Does this mean we should all be paying attention to those commercials that are every 20 minutes on TV?
I think we should. I mean, it's not clear how gold is priced right now. Remember, you price these kind of assets with certain future expectations. So what expectations are priced into gold at these levels in terms of inflation? But I would say everybody should be considering it because it's a way to protect your wealth, unless it's way overpriced, which I doubt. And it's clear that in the future, governments in the U.S., governments in Europe, ultimately even the Chinese government, because their banking system is in trouble, are going to have to print large quantities of money, create inflation, which lowers the value of the debt, but of course messes up our net worth considerably because our cost of living goes up dramatically with inflation. Gold is a good hedge against that.
Into hard assets we go, right? Out of cash and into hard assets?
Well, not
that we're an investment advisory group here, but it seems if we're looking down the road,
to me, well, bonds anyway are a very, very iffy circumstance right now. I mean, if you're going to be in bonds, you're going to take some nasty damage.
Now, Terry in the IBD editorial said that maybe the entire EU should just be dismantled. I mean, it's completely dysfunctional. The euro has not done what it was supposed to do. There were supposed to be all these rules that were to prevent this about GDP, debt, all this stuff. Turns out everyone was lying, or the compliance wasn't there in terms of monitoring it. So, is there any hope for it?
No, there really isn't. I think ultimately they will have to dismantle, and largely because the economies are so different, the cultures are so different. Their tolerance for things like inflation are so different that you cannot get a unified policy out of the two, and using one currency for all the continent means they have to have one monetary policy, and now they want to create a treasury, a super European treasury for the whole continent, and it won't work.
And it's got to stir up hostilities that it was meant to sort of allay, because if I'm a German taxpayer and I'm footing the bill for Greek entitlements, that can't do something to foster the community between the...
No, absolutely. And this is more than entitlements. This is the whole structure of the Greek economy is built around the centrality of government and government waste and government expenditures. And this is that's the model over there. But look, the Eurozone can be saved. I mean, there is real value in monetary union. And the way to save it is to let Greece fail. If Italy's going to fail, let it go bankrupt. Now, it would really be hard on the banks in the rest of Europe. But let's flush out this crap. Let's get over it. You don't have to print money because you've got a printing press. You don't have to bail out people because your banking system might get in trouble. And the easier thing, in my view, to do is bail out the banks than it is to bail out these countries. Because what happens when you bail out the countries? Now you've got moral hazard on a country level.
Right.
So now these countries are just going nuts. You know, they'll continue to spend. Nothing will change. Let Greece fail. If Italy has to fail, let Italy fail. Yes, it'll create real havoc in the rest of Europe, but you'll get out of that havoc.
Get out of it
what you're doing right now is just continuing. And what happens if they go off the Eurozone, off the Euro? Each country will go back to its own currency, and we'll see, other than Germany, we'll see every other country have double-digit or even triple-digit inflation rates, so the people there will be devastated anyway. Take advantage of the benefits of the Eurozone, and just let it happen. And maybe this is an opportunity to fix those economies. But we know that's not going to happen. So that's my fantasy anyway.
That's your fantasy. Yaron's indulging in a fantasy there, everyone. All right, gentlemen, thank you for Yaron and Terry. I'm Alan Barton. Thanks for watching Front Page.